Good afternoon, everyone, and thank you for joining us for this webinar on equity investing in climate solutions. My name is Gladys Gachu. I'm the Communication and Admin Associate for the Intentional Endowment Network. For some of you who may not know what the Intentional Endowment is, we are a nonprofit collaborative peer learning network where endowment and experts come together to forward climate action together. We do this through forums, events, peer learning, networking, and sharing useful resources on sustainable investing opportunities and providing educational venues like this one today. You can become a member as an asset owner, an asset manager, and any other stakeholder to keep this movement growing. And also you can join for specific programming for non-members. Also, you might have heard about our climate action pursuit going on now. We're excited to let you know that we are now open for the June session registration, which is going to be in June 10 to June 11, 2021. You're welcome to check our website to see who will be our panelists, our sessions, and our agenda. We look forward to having you for that event. I will then give you a little bit of the logistics for this webinar. So you are all muted for now. All participants are muted for now, and this session will be recorded and shared to everyone who has joined this meeting today. You can use the chat section to write any comment or questions you may have, or the Q&A. If you wanted to go to everyone in the panel or everyone participating to this event, please use everyone when sending your comment. We look forward to hearing from you and the questions you may have for our wonderful panelists. With that being said, I'm going to pass it on to George, who is going to take over. Thank you.
Thank you so much, Gladys. Hi, everybody. George Dyer, Executive Director of the Intentional Endowments Network. And so pleased you all are joining us today for what will be a great conversation. This webinar is part of our series, an educational series on net zero portfolios and supporting endowments in making commitments to net zero and implementing them through our Net Zero Endowments Initiative. And this is relatively new, but really gaining steam. And we have formed a steering committee around this work that met for the first time last week, and more resources and activities will be coming out soon. So please stay engaged and help us move these conversations forward. Our first speaker will be talking a little bit about what net zero commitments are and defining them. So I'll hold off on that. But did just want to mention, as we dive into this work, we are really focusing throughout the Intentional Endowments Network on racial equity investing and DEI in the investment process as well. And so looking to approach these in an integrated way, looking at how climate solutions impact communities of color or marginalized groups, and how we navigate this transition to reduce and not exacerbate some of the inequalities in society, which we think is critical to this work. And we'll be discussing some of those themes today, and also having more sessions as we move through the year that really dive deeply into that intersection. So with that, I want to dive into the conversation. First, just ask all of our panelists to just quickly introduce themselves to kind of get everyone's voices in the room, and then we'll dive into the substance. But Elke, do you want to just say hello quickly?
Yeah, hello. This is Elke Pfeiffer from the Secretariat of the Net Zero Asset Owner Alliance.
Thank you. And Li Chen?
Hi, everyone. My name is Li Chen Ma. I'm the head of the Sustainable Investing Research Team at Cambridge Associates, and I look forward to speaking with you all today about this important topic.
And Temple?
Hi, I'm Temple. Thanks everybody for joining. I am Managing Director of an early stage clean energy venture fund. I'm also a family office. We're actually in the oil and gas business, but have been investing in clean energy and regenerative agriculture for more than 15 years.
Great, thank you. And Bill?
Thanks, George, and thank you, Gladys. Bill Page from Essex Investment Management, and we're a thematic listed equity boutique based in Boston and Chicago, and I'm focused on clean energy investing in a strategy called GEOS. So thank you for hosting this, George, on climate solutions today.
Great, well, thank you all. And yeah, so, we'll be diving into both private equity and public equity climate solution investing, but kind of to set the stage, a bit. We'll start with Elke. And Elke, if you could just share an overview of the Net Zero Asset Owners Alliance, what it is, including the track that you lead around financing transition, and kind of set the stage for about how investing in equities, both in public and private markets, can lead to the transition in the real economy.
Yeah. Thank you very much, George, and thank you very much for giving me the opportunity to be part of this great panel, and for giving me the opportunity to present the UN-convened Net Zero Asset Owner Alliance and the financing transition work within the Alliance. Good to meet you all. So before I introduce the Alliance, could you please flip to the next slide? Here you would see the logos of the members, but then right away to the next one. Let's discuss why need asset owners drive net zero. We, so the Alliance members, strongly believe that investment portfolio alignment to net zero greenhouse gas emissions addresses three important themes. It addresses reducing transition, but also physical risk exposure in asset owners' investment portfolios. So it's all about risk management. But it also addresses AO's fiduciary duty as investment portfolio decarbonization reduces risk in terms of stranded assets, but also we expect investment opportunities due to new growth markets in green technology and innovation. So it's about returns and investment opportunities. Capital reallocation will spur climate solutions. So resilient investment portfolios will lead to resilient economies and resilient environment to the benefit of the planet and future generations. It is about social responsibility and adopting a long-term view. And as 70% of the global emissions are already covered by a net zero goal, it is inevitable that as countries turn national commitments to credible policies, every sector will and must be transformed. Therefore, for long-term investors, long-term sustainable strategies are decisive. And if you look at the chart on the right-hand side, you see in blue the carbon budget for limiting global warming by 1.5 degrees. And to avoid the worst for the planet means that the real economy must decarbonize by 50% to the year 2030 and roughly 25% to the year 2025. Could you please flip to the next slide? For now, we are 37 members across Europe, North America. I say Europe because we are unfortunately highly overweight in Europe. So we desperately look for additional members from North America, Australia, and Asia. So we basically cover the globe already. But as I said, especially North America, Australia, and Asia, it would be fantastic to have more members to really be able, as it's a global agenda, to be able to cover and to discuss also with regulators and policy across the globe. For now, we have asset owners with assets under management of $5.7 trillion US. And so what is the commitment? The commitment is to decarbonize investment portfolio by 2050, but setting also intermediate 5 years target into report progress against this target. It is, but it is crucial to understand part of the commitment is also are also engagement activities being identified key to achieve this overall goal. So without policy, corporates, and all other stakeholders, a net zero economy and a net zero investment portfolios cannot be achieved. Please flip to the next slide. And this is kind of key, the net zero asset owner theory of change. The idea about this commitment is at the first place, not so much to de-risk investment portfolios, Yes, this is a goal, but in the first place, it's really to achieve this via having real-world impact. And how can this be achieved? So you see on this slide in green, what is framed in green, these are the layers we feel and we think and believe are of highest impact to engage with corporates, with corporate associations or sector associations, with asset managers, with policy, but also investing in climate solution will have real world impact on a macro level. So what you see in green is basically the real world impact on a macro overall global level. What you see framed in blue is a portfolio alignment of an investor's portfolio, which also will have a real world impact, but it's possibly not as strong as engagement and investing in climate solution. This is sector rating, sector reallocation, so across sectors and asset classes, but also within one sector reallocation, so with the best-in-class approach to shift capital to those constituents which are on a net zero pathway. This is kind of the thinking. And what is also important to understand, the Alliance members, and this is why we put reallocation, allocation, the Alliance members do not promote divestment. The idea is to finance the transition, to support the industry, especially the hard to abate sectors, by best-in-class approach, by investing in climate solutions, and to engage with asset managers, corporates, as I said, sector associations and policy. And to align investment portfolios to address the risk, but also to as I said, to shift the capital to the consistent on a net zero pathway will have an impact for sure. And this is the reason why we have or look at those 4 different layers in the Alliance. And as I said before, the commitment is to commonly engage. We have the members work in working groups to achieve and to work on all these different themes. And to come back to your questions on the financing transition work stream, we discuss different kind of themes. So one of it's blended finance vehicles, private public vehicles with public and money or public contributions for de-risking, and to spur these instruments via a blended finance call to action, which you will find on our websites. We are proactively discussing with the asset managers, with also the Net Zero Asset Manager initiative, to come up with those vehicles and to commonly build them. So we try to connect asset managers with donor capital to spur these kind of blended finance vehicles, which are needed. De-risking, as I said, as you know, financial institutions or like the asset owners in the Alliance need an attractive risk return profile to fulfill the fiduciary duty. Therefore, de-risking is needed. Another theme is that we discuss nature-based solutions, technology-based solutions. And with this, we discuss voluntary carbon markets. So we are also consulting the task force of scaling voluntary carbon markets to achieve credible, transparent, and liquid markets. And these markets are needed to transition to the end goal, to a net overall net zero end goal. These markets will be needed, but we all understand they need to be credible and transparent. What we also discuss is climate solution reporting, which could feed in TCFD reporting. So discussing what are green solutions, what is a transition corporate. This is also not at all easy to understand. EU taxonomy gives us some, let's say, provides a lot of input here, but all of this is not yet clear. So this is what we discuss. We look into climate benchmarks. We all understand how important benchmarks is, because nearly every asset owner steers the investment portfolio via benchmarks. So the idea is to understand those climate benchmarks, to understand the implications, and to, in the end, be able also to assess them and possibly engage with index providers, but also the EU Commission, because the EU Commission, as you might know, came up with the Paris aligned benchmark and transitioning benchmark, providing giving guidance. Also, this is what we in depth discuss and try to understand, and especially work on more transparencies for these benchmarks. Last but not least, giving another example, we also commonly collectively engage with asset managers, also giving guidance to the members how asset manager engagement can happen. And you will, for example, find on our website also a guidance. It's a foundation for asset owners engagement with asset managers on proxy voting approaches. So last slide here, you see the target setting, which is basically the core of the alliance based on what I just explained, this theory of change. We think that this 4-layer target setting is crucial to achieve what we want to achieve, portfolio alignment to net zero, but with a real world impact. So not via divesting, but via real world impact. And therefore we recommend to set all of those 4 targets, engagement targets, sub-portfolio decarbonization targets, sector targets, so sector intensity reduction targets, and last but not least, financing targets. This is giving you a rough overview. So if in case you want to understand more and learn more, please find out on our website the target setting protocol, which you see here on the right-hand side. It's a 70 pages paper and addressed to me anytime. So happy to give you more insight and input. Thank you very much. Over to you, George.
Great, thank you, Elke. And we can also, we'll have a larger presentation to share around with the group after from the Alliance as well. So Licha, I'm going to turn to you now and just ask what you're seeing in terms of institutional client interest on net zero and climate solutions, and if that's driven more by kind of the reducing risk or seeking opportunity aspects of that Elke mentioned, and also how you and your clients are thinking about equity and racial justice as you approach this topic.
Yeah, absolutely, George. And thank you and the IEN team again for putting together this really important conversation. In the next few minutes, I'll talk about 3 key topics. One, what are we seeing at Cambridge Associates on our client and the broader institutional investor universe around sustainable impact investing, net zero? And 2, really what net zero and investing in climate means, how it's being implemented in institutional portfolios. And Elke, that was a great overview to kind of frame the broader conversation with net zero. And thirdly, as you've pointed out, George, the intersectionality here is really, really important with broader DEI, racial justice, and racial equity considerations. So I'll try to hit on all 3 of those. Number 1, just on the broader institutional investor landscape, I think the direction of travel is very clear. We're getting inbound requests every day from existing clients, from new clients around sustainability, climate change, racial equity, gender equity, all of the above. And just to give you some numbers around it, we run a survey every 2 years. This is actually on our public website. You can take a look at it under Insights. We run a survey every 2 years. The first year we started doing this was in 2016. We asked our respondents, mostly endowments and foundations, how are you engaging with your portfolio around sustainability and impact? 2016, it was about 31% answered yes to the question of, yes, I am engaged in some portion of my portfolio around sustainability or impact. In 2018, 2 years later, it was about 36%, so it ticked up a bit. And last fall, it was actually over 60%. So a remarkable trajectory that we're seeing. And of course, that's across all themes, right? There are clients of ours who are particularly focused on social equity issues. There are those particularly focused on climate change and resource efficiency. And what we are finding is that there's real overlap and intersectionality that we want to lean into and kind of converge the world of mission-related investing out there. And I also would posit that, you know, the pathways to the table around sustainability is multifold, right? So some endowments and foundations have come to this out of pure mission alignment, right? And or stakeholder engagement and alignment around, for example, divestment or other, you know, activism on campuses, you know, in board meetings, et cetera, donors. And that's what initially catalyzed them to get to the table. In the world of family offices, as Temple can speak to later, perhaps, you know, the next generation family members are very much focused on, you know, their legacy, their impact, their real world mission as they engage with the older generations on portfolio decision making, and that's led them to the table. And with certain other institutional investors, it's regulatory, right? It's driven by, you know, especially in Europe, it's driven by, you know, mandate, and you have to take in ESG considerations into your process, into your outcomes. And that's what initially got them to the table, right? But I think the most important one that I haven't talked about is, regardless of those pathways, the financial materiality is the one that will keep people at the table and what is going to really make this scalable and sustainable, right? Because the universe of attractive opportunities and the factor of risk mitigation around climate change, around important ESG risk factors, you know, those are what's going to drive, you know, long-term asset owners to really deeply incorporate these factors into their process, into their decision-making, into their portfolios, because all of these, if not, you know, at least a substantial majority of these institutions are long-term pools of capital that should be designed for and managed for not just the next 3 to 5 or 10-year returns, but the next few decades. And we view climate change and social inequality as systemic risk factors that affect all of this. And if we don't stabilize and risk manage those systemic risks, right, the whole system is unstable and will not allow us to generate economic and societal value. Specifically around net zero, I think Elke covered it very well. I think the conversation has definitely evolved from one of a silo, right, looking at pure clean tech, you know, in the early days, or pure exclusion around fossil fuels, whatever variation there may be in certain settings, to much more holistic integration. And so I think the net zero approach works really well because it doesn't corner the conversation around one specific asset class or one specific sector, let's say, you know, fossil fuel producers. It really broadens out to be applicable to your entire portfolio, equities, credit, alternatives, you know, around climate, you know, transition risk, you know, and physical risk, right? You should be incorporating those types of questions into all of your due diligence and engagement with managers. And I think the opportunity set has broadened to a sense that, you know, it's not just within the electricity generation or power generation sector, it's not just within transportation, but it's across manufacturing, you know, real estate, food and agriculture, water. You know, there's so many huge sectors that relate to our carbon intensive economy, where I think that across, you know, public and private asset classes, there are real opportunities there. And you'll see that and hear about that from both Temple and Bill. And I think the returns have also improved. And this is from Temple's slide, which I'll just preview here. Again, this is also on our public website. We track data around clean energy companies, clean tech companies in our private investments benchmark. And we've actually seen very strong rebound in the returns since about 2013. You know, in the 1.0 era, we saw, you know, lackluster, if to be generous, returns. And since 2013, it's really rebounded across different stages and across most sectors. I think that's driven by the talent that's coming in, the technological innovation, the business model innovation, the policy and regulatory, you know, landscape, and consumer behavior changes. So I think that's all very optimistic and encouraging. But I think not to ignore the intersectionality, right? As we transition, we know that climate change disproportionately affects marginalized communities, underrepresented communities, both in developed markets as well as in emerging markets. In fact, the World Bank, one of their reports said that by 2050, climate change will have displaced 86 million people in sub-Saharan Africa, 40 million people in South Asia, 17 million in Latin America. And if you think about the potential risk around climate migration, that number could be much higher. So systemic risk across the board, and that racial equity, that socioeconomic disparity exacerbated by climate change, we have to take into consideration when we're viewing viewing portfolios. And also in the transition, if you think about the new energy or new climate sectors, right? We want to make sure that the workforce powering those new sectors and growing sectors are inclusive. I'll just take one example, the solar industry, really important for the climate transition. African Americans, at least in the US, represent about 7% of the solar industry workforce, 7.5%. African Americans represent 13% of the overall US workforce, but it's only 7 to 7.5% of the solar workforce. So really important that as we grow these industries, it's inclusive and we have an intentional focus on racial equity. And also as we invest in these solutions with managers, with companies, that we have our clear DEI intentionality in mind and engagement as we transition. So I'll leave it at that. Happy to answer questions later on or throughout this discussion. Thanks, George.
Thank you, Chen. And yeah, that was great. Covered a lot of ground there and some important pieces to continue to give us some of that context. And Temple, I want to turn to you now and just share a bit about your work around private market climate solutions and what you're seeing in terms of that performance question that Chen touched on, the impact of these strategies and what it takes to kind of get them to scale.
Yeah, thank you, George. And could you put up the slide, the last slide with the return? So, I really want to give a big shout out to Li Chen and Cambridge Associates, because they really have been doing phenomenal work for years. And then, in fact, there are two papers that Li Chen wrote, one he co-authored with CREO called Pathways to Sustainability. There's a second paper called it's Risk, let me get the title correct, it's Risk and Opportunities from the Changing Climate. Both of them are excellent papers. Now, that Risk and Opportunities, Li Chen wrote, 4 or 5 years ago, and it's still as relevant as if it was written yesterday. So I highly recommend people looking at those papers. But yeah, and another paper to really look at is the PricewaterhouseCoopers. It's really the most recent paper that's come out and analysis it's done. And the paper's called The State of Climate Tech 2020. And what's interesting about that, Gladys, if we can go to the next slide. What they were highlighting, if you look at what's happening right now, you've got more than 1,500 global companies. This is the stat on the right, that have actually made pledge to net zero targets. And what the report really points out is that the technologies that are needed for these companies across many different sectors of airlines and pharma and data centers, those technologies actually they're not available right now. They're not, some of them are still at the conceptualization phase, some are in the R&D phase, but there are very few that are commercialized. So the innovative technologies required for these companies to reach net zero just don't exist in the market. If you go to the next slide, please. And what it's causing is this major snowball effect of demand. And as you can see, it is completely sector agnostic. And particularly this bottom row of airlines that are pledged to be net zero, there really is no way for them to get there with existing technologies. You can't just build more windmills and solar farms. And so this really, this innovation, this climate innovation is absolutely required. The problem is there's very little capital for this, for the innovation. And in fact, if you go to the next slide, please. And so what we're seeing is there's actually a fair amount of capital that's over here on the left side with the government grants and industries. And there's a massive amount of capital that's formed in the growth capital with KKR and G2VP, which is the Kleiner Fund, Apollo, Bain, TPG, Rise. I mean, you're talking billions and billions of dollars that are ready to fund and scale these growth companies. The problem is there's very little capital that's being targeted for this innovative technology to help these companies cross the chasm. So many of these technologies are essentially dying at the bottom of this pit, and they're not actually reaching the market. There are a number of broadly sustainability funds that have formed that are covering everything from Beyond Meat and Impossible Foods to water and consumer packaged goods and more economical ways to roast coffee. But there are not very many that are actually focused on helping these technologies move from this pre-commercialization phase into an actual growth phase and a commercialization phase. And in fact, if you look at what's being funded here, even this VC, between this period that Li-Chin was pointing out, the 2013 to last year, 2019, there's only $60 billion across those 7 years was actually focused on innovative climate solutions. I mean, it's an absolute pittance of capital that's supporting these companies trying to cross this chasm. And in fact, if you actually peel back the onion on that 60 billion, less than 5 billion has been committed to the energy part of this, which means energy is the grid optimization, the storage, the energy efficiency, new ways to produce electricity, less carbon intensive fuels. Literally less than $5 billion has been devoted to that kind of commercialization over the last 5 years. So there's a huge dearth there. The other problem too is that people continue to believe that the U.S. is a leader in innovation and in climate innovation. The reality is that we're not. We're falling significantly behind China. And in fact, if you look at according to the World Economic Forum, if you look at what's being devoted to renewable energy R&D, China is spending approximately twice what the U.S. is spending. So it's spending about $90 to $100 billion versus the approximately 50 of the U.S. for the R&D. And in fact, if you look at how that's being materialized and commercialized, China actually has 1.5 times the patents in renewable energy than the U.S. does. So we're falling behind not just in the capital that's being devoted and committed, but the actual development of that technology. We're significantly losing the patent war here, which is it's really depressing. And we've spent a big I as I mentioned earlier, I'm part of a family, so I've been an LP in a lot of these funds, but I'm also have my own fund, and I'm quite friendly with a number of institutional investors. When we talk to them about what are you doing in terms of investing in early stage venture, what I'm finding is a lot of them are, in fact, even the ones that are allocating to VC, a lot of them are actually overweighted in VC because the VC, their early VC that they've started in building vintages back in the early 2000s, which are the Sequoias and the Tiger Globals and the Andreessen Horowitz, they performed so well that they really just don't have any additional allocation for VC. So new funds like ours, whether VC and private equity, they don't have any additional allocation. So needs to be a rethought on how do they move some of that VC allocation into supporting some of these climate solutions. And we did a report at Harvard. And we basically looked at the institutional investors that were members of IEN or a serious investor network addressing climate risk. And there were approximately 100 institutional investors managing about $3 trillion. And what we were finding when we were doing the research, like why are they not allocating to these VC and PE funds? We ran into a number of things. One is they weren't aware of the data that Li-Chin, and his team created around how the returns have actually outperformed VC and PE overall. They didn't want to take the reputational risk, but they weren't considering an investment in a venture capital fund that was addressing climate change into their layered J curves of their overall allocations. And so if we could have the next slide. And this was something that was brought up to me by a couple of the investment teams. And they said, honestly, it's very hard to get our team and our investment committee to focus on this because we're not layering the J curve. So if you can just advance to the next piece. So, these funds typically have, relatively long durations. So they're typically 10-year funds, and they may have like 3 years of extensions. And the reality is a lot of the members that are on the team, they're at these institutions for maybe 5 years or 7 years. If you can go to the next slide. So they may have a career duration that's significantly less than the investment duration. And so to ask a relatively young investment professional to make a commitment here is actually misaligned with the investment decision. And so, this is going to look like a negative return because you're drawing out of the liquidity pool to be able to fund these capital calls. And then on top of that, I call it the paradox of the 12s. They're measured every 12 weeks, which is a quarter, and they're compensated every 12 months. So you can go to the next slide. And so they've got this compensation cycle. They've got these other mini J curves. And to ask them to actually invest in some long duration that's not part of a mandate or an existing strategy is actually asking a young investment professional to make something that's against not only their career duration best interest, but it actually is potentially reducing their compensation because it's taking away from the liquid alpha they can do, the liquidity they can use to generate alpha. So there's a big misalignment that we're seeing when we're talking to the investment teams.
Great, thank you, Temple. And I'm going to turn it over to Bill now. Bill, we're running a little behind, but definitely looking forward to hearing about the public equity side of all of this, particularly small and mid-cap companies and what you're seeing there. How you think about investing in climate solutions in that space, and what are the risks? What should investors be looking out for if they're going to dive into these strategies in the public markets?
Hey, George. Yeah, let's go to the first slide. Hannah, thank you. Yeah, so I'm running a clean tech strategy in listed equity. So as you move past Fennel's world of private equity, moving into listed, and this is public equity. So when a lot of asset owners think about clean tech, they tend to think about private, but you can have a very high significant impact using listed equities, provided that you're investing in climate solutions and technologies around climate solutions. So this, many of you have seen The World at Night. It was compiled by NASA Geospatial Technology back in '09. And I like it because it really sort of isolates those economies that are guilty of the carbon that's been in our atmosphere for 250 years. So if you look at the high light emitting areas here, those are the developed markets. And so if you think about wood, which is a 10-to-1 ratio of carbon to hydrogen on an atomic level, those wood emissions that powered our economy pre the Industrial Revolution are still in the atmosphere. Then we moved to coal and oil, and now we're at natural gas, which is a transition fuel, at 1 to 4. But the reason why I like this slide is that it really speaks to the demographic and economic changes that cause climate by the developed markets. And so as we think about harnessing energy for all in the regions that don't have high ambient light, that's what we're investing to, is solutions for the next energy transition. And so what I'm doing in a listed equity global portfolio that's focused exclusively on climate solutions is investing to those solutions. And there's a lot of market cap. So if you think about the chasm is in Fennel's terms, there's a ton of market cap around solutions. Go to the next slide, please, Hannah. So I think we've covered this throughout the presentation, but when you think about moving the needle, I've been focused on clean tech investing for about half of my 30 years of ESG investing. So I was sort of in Li Chen's terminology parlance, I was in the clean tech 1.0 arena. And back then, you didn't see, if you think about the catalyst on the left there between global climate commitments to net zero, government, and then corporations. So we've seen massive increases on the part of corporates investing in clean tech and renewable energy. So that's first and foremost, I think, to me, the greatest example I can give of the commercial viability of clean tech solutions and what I'm now calling clean tech 3.0, which by my measure started in 2018. So Elke really presented, I think, what we see on the right there, but COVID has really catalyzed commitment to climate. And there's also been a convergence of social with environmental and with climate commitments. And I think these commitments are great. scaling capital is what we need. And so what I like about the discussions, we've seen over 53% of global GDP committed, and these are loose commitments to net zero. That's all well and good, but now we need to move the capital to the solutions. And so that's why I'm investing on the listed equity side. Next slide, please. So to me, I define thematic investing as investing for secular change globally. And so when you invest in new energy and disruptive technology, I believe one needs to have a thematic approach. You can't look at SIC codes. There's too much change in these technologies. I do define these 9 themes as clean technology solutions. So many of the listed equity solutions that are out there tend to think about clean tech in silos, so renewable energy, solar and wind. But all of these themes enable clean technology solutions, which I also define as resource efficiency. So doing more with less. So powering an economy with less British thermal units of energy. Energy efficiency is really key. Power technology. The other thing, to a point that was made earlier, is that these technologies are maturing. And so we're seeing a convergence in many of these themes. And this is also exacerbated by the pandemic. And so if you think about the clean smart city, so that's in our clean tech efficiency theme, really key theme is you think about the drive towards level 1 autonomy for cars and electrification of the car, that's efficient transport. Those technologies are reliant on the theme to the right, which is power storage. And so what's really interesting is the ecosystem that are being created as these clean technologies commercialize. And to George's earlier question on the just transition, we know that those with the underserved and less served are the ones that are being hit the worst by climate, but also we are also solving for things like ambient air quality in the inner city, which is in the clean tech efficiency theme. So really, really key issues. So this thematic approach, I believe, this goes back to work that was done by Princeton and close to 20 years ago. There's no one silver bullet. You need to have a broad palette of approaches technologically to solve climate, social, and other environmental issues. And so that's our approach in the portfolio. The sub-bullets there are the current exposures we have by industry. Next slide, please. So to George's question on impact, I believe very strongly that you can have very significant impact in the listed equity market, provided the asset owner has exposure to companies which are focused on solutions. So that's really key. So we're moving beyond what I call input analysis. So input analysis is focused on, it's where almost all of the ESG assets are invested, which are in companies that have good behavior. And when you have good behavior and you're as big a company as Walmart, you can really, that tail moves the dog as far as supply chain analysis and output in what they're doing for their suppliers. But on output, this is what I call solutions investing. So output investing is investing in technologies that solve climate. So it's investing in LED lighting or energy efficiency technologies, those technologies that are being developed and influenced by the companies that I mentioned earlier that have net zero targets. So output is something that's really critical. It's something that I loved it when I saw the SDG development, furthering the UN development goals from Millennial Development Goals of 2000. So the SDGs provide a common framework that we can use to scale capital into climate solutions. So we are solving with GEOS, the strategy I'm running, 9 of the SDGs, and some are higher impact SDGs. We've done a 2-year project where we've been mapping our theme to the SDGs and then engaging with each of our companies around SDG alignment and solutions. And so when I say engage, it's not trying to turn around a battleship to have better behavior. It's working with a smaller mid-cap company, educating them on what the SDGs are, and then providing a framework we can take out to the marketplace to try to scale capital into these stocks, into this portion of the equity market. So it's a really key, critical element and nuance of what impact management is. And so to give you an example, we've actually talked to some of our companies about selling down some of their technologies that are being sold into antiquated fossil fuel industries, developing core competencies into new end markets that are scale and that are more commercially viable. harnessing companies and engagement around SDG frameworks and case studies that they can bring to the capital markets in their quarterly earnings disclosure, but it also enables them to have a better sustainability report. So they can talk about not their own actions, but what they're doing is they scale capital across and scale their technologies across their customer base. And the most important thing here is that, yes, indeed, the holy grail is a carbon offset number, a water offset number at the portfolio, but we need to walk before we run. This has been, it's all heavy lift. There is absolutely no data out there in the ESG framework that can help us with this. So it's our engaging with the companies. So George, I'm gonna hold it there. We can go into maybe some just transition examples in Q&A because I have a few. Thank you.
Great, thank you all. And just a reminder, keep questions coming in. We have several from you all pre-registration and a couple live here, but keep those coming in and we'll get to as many as we can here. And I just want to start with a quick one out there that came in while you were speaking about the divestment question. You know, it's been an interesting part of the conversation in our network, and I think some of the interest in net zero is that it's not necessarily mutually exclusive with divestment. But the question here is divestment on the table at some point for the Alliance if companies fail to meet interim net zero targets? And so can you speak to that and how that?
Exactly. I mean, the idea is not to have like a divestment strategy. Of course, if you know, after like 5-10 years of unsuccessful engagement, this will be a last resort. I mean, as anyhow, the asset owners steer their investment portfolios, you know, the decision, basically the strategic also is the strategic decisions, but also the tactical ones are anyhow within the single asset owners, right? So from the Alliance, there is not like a divestment strategy or proposal. We also, from a legal aspect, we could not, you know, commonly have like a divestment campaign. This is also what we cannot do, right? So, but divestment for sure might be a last resort. This is the answer to it.
Great, thank you. And we had another one about, you know, as asset owners look to hold managers accountable on carbon net zero DEI goals. A question about standardization or standardized surveys being created that managers can respond to in a more consistent fashion. I know this is something we hear a lot in the ESG space generally. And Lee-Chan, I wonder if that's one, you know, if you have any update on the latest state of play around that.
Yeah, absolutely. I think we're drowning in surveys, and by we mean the institutional investor world, both asset owners sending the surveys as well as the asset managers receiving and responding to the surveys. I think there's obviously a lot of good intentions around getting the data, getting the right information to make good decisions. But a lot of it is redundant. A lot of it is, you know, or can be improved in terms of the rigor and the thoughtfulness, and again, especially around intersectionality between different areas. So, you know, I would say that there's definitely some industry movement around this. I know there's a working group in the UK with industry investment advisors. There's one here in the US. And we are working more with both investment managers and data providers to make this more uniform, and including with for example, the ILPA, which is the Institutional Limited Partners Association, to try to standardize some of the questions. But I know that's more focused on private markets than public markets. So several initiatives going on. I'd be happy to address them, you know, more offline, but it's absolutely an issue, but I think it's also a reflection of just how early we still are in some of the, you know, the real data collection and verification reporting piece. And it needs to kind of metabolize and make sure that we get to the right output. And frankly, we may not have a right output anytime soon. I think it took a Harvard Business School professor told me that it took about 100 years to get to our current financial accounting standards, right? And we are probably in year 5 of, you know, sustainability and impact reporting standards, if that. So this is going to take time, but I would urge everyone to, you know, not be overwhelmed by all the different data and noise, but really lean in and engage and try to work at a more uniform and thoughtful approach.
Yeah, we had a couple of other related questions around just the quality of data and measuring impact, which I think you spoke to there, but just wonder, Bill, Temple, or Elke, if you have any other thoughts on those themes broadly.
Yeah, the Alliance also works on the data aspect. So, so we commonly work with other initiative on open source climate. So the idea to have like, one kind of standard carbon emission data pool, not only on carbon emission data, but also on stress testing and climate solutions. Let's see how this goes, but all Alliance members are part of this initiative, and we hope to have like open source accessible huge database for everyone to ensure to have consistent data, because this is especially on scope 3, everyone knows how huge the gaps are, and we commonly need to work on it, and disclosure is key. First of all, you need disclosure, especially also on forward-looking pathways, on CapEx, because investors are forward-looking, right? So it's not the footprinting. And this then needs to be collected in one huge database, and we think it's most powerful to have like a large, pool, which is used by many AOs, not to crowd out the commercial ones, kind of. But yeah, this is what we think is most powerful. Yeah.
Georgia, I'd also say, for folks not to let perfect be the enemy of the good, they can be good enough. I mean, look at what CDPQ did. They made a very bold, carbon budget, and you've got to get in the water. And I feel like people use the measurement and metrics as an excuse to kick the can down the road.
Yeah.
Many people just want to kick it long enough so that they can finish their career at the institution. They don't have to take the risk. It's like they don't, and so that's a big problem. And the private side, we're actually are leading a few initiatives. So the Impact Capital Management Group, I mean, we're standardizing an impact report for the VC and the PE funds that are in impact. And for clean energy in particular, we developed a model called the Simple Emission Reduction Calculator. That we unitize each service delivered or product sold with this particular carbon life cycle, and then you can just multiply it by the scale. And we're getting, and it's a very sort of simple, actionable metric. Is it perfect? No. Is it good enough? Certainly.
Great, thank you, Temple. And just on that one, those surveys with the impact capital managers, is that something that asset owners will be able to access and use, or?
Well, yeah, we hope so. I mean, we're still early. We're collecting data amongst ourselves to try to create best practices. Gotcha. And it's very frustrating for the asset owners, like particularly the fund of funds, because we're all reporting different things, and some reports are 3 pages and some are 60 pages.
Right. Great. Bill, we've got another one for you. Given the strong public equity performance in the last year, how do you see valuations going forward and opportunities if an investor is just starting into these sectors and looking at climate solutions?
Sure. Yeah. Well, I think back let's talk about Clean Tech 2.0, which was a 10-year period, which started in 2008 and ended again in 2018. The S&P 500 was up 260% during that period. Wilder Hill, measure of clean tech, was down 60%. 10 years, down 60%. So if you think about what drove the capital markets the last 5 years, it's been 6 large cap quality growth stocks, full stop, right? So we're invested in industrials and technology, mid cap, small cap. The valuation forward growth rates of this sector, I'm very constructive on it relative to the broad market. And then the other thing that's happened is, yes, indeed, I do concur that there's been a significant, I think about Temple's chasm. We talked about this earlier in the week about what happened with what's called SPACs, special purpose acquisition companies, which filled some of the gap. And there's a lot of SPACs out there that are directed to clean tech, and there's been a significant correction in those names, most of it warranted. So a lot of these are sort of went public way pre-commercial. But I will get to the fact that after a very strong year last year, probably a little bit ahead of our skis relative to what's happened, right? So the Biden trade could have been in some of that movement in clean tech. But again, when I look at what's happened year to date, we've had a correction in clean tech year to date. And so our portfolio has held up quite well, but solar's down 35%. And then we've got clean tech down 40% year to date. So we've sort of reset ourselves a little bit as we're in the midst, almost done with earnings season. So we are, and then as we think about our characteristics of our portfolio relative to last year, we've seen a significant improvement in valuations relative to growth. And the good news is that denominator on PE, I think, is going to be improving. And so there seems to be a big mismatch right now in the marketplace on what's happening with regard to clean tech. The fundamentals are getting stronger and the market's been extremely volatile. So I think it's an opportunistic time now for clean tech investing in listed stocks.
Great. So we've just got a couple of minutes. I was hoping to come to one question around shareholder engagement. There's a question if that's a consideration in all of this. So if we get to that, we can speak to it more, but I think the quick answer is yes, definitely it is. But before we get there, Bill, you said you had some more thoughts on the just transition and Temple. I know you all have been doing some work around this as well. And if you can just share, maybe starting with Temple, maybe some of the work that you all have done with Brown in the green space or other activities you've been involved with, and then Bill, maybe go to you on just transition.
I'm going to go for 30 seconds and then give it to Temple. So the just transition is something that's really critical and important. So when you think about solar, one of our solar names is Sunnova, interestingly enough, based in the energy capital of the world, Houston, Texas. They hired 25 former oil and gas workers because we don't want to have stranded workers in the new energy transition. And they're about 56% minority in the firm. So it's something we engage them with. And then just thinking about technologies, significantly, what's happening in Appalachia and food deserts. So there's an interesting company in our portfolio that is meeting the needs at a 41% greater than the average wage in Kentucky with an indoor greenhouse technology that has no fertilizer runoff and uses 90% less water than an outdoor farm. So I'll pass it to Temple and Li Chen.
Yeah, so and again, everything that I'm doing is focused on the VC sector. So we're part of a group called Diversity VC, and it's actually a certification that you need to basically earn. And so we're really promoting that amongst our peers. More than 50% of our portfolio have women founders or people of color. But we're also, when we're looking at this space, unfortunately in the last 30 years, the energy sector has been primarily dominated by white males. And so it's really about building the bench. So we are very focused on building the bench of talent across diverse sectors. And that's what kind of Brown in the green space is about. And it's also, when you're looking at DEI, diversity, equity, inclusion, the inclusion piece is a really important piece. So when we have a big intern class every semester in summer, a third to a quarter have to come from community colleges or what are considered gateway cities up here. So it's quite easy for us to find a diverse set of brilliant people in Cambridge, but you also need to reach out to other communities and give opportunities broadly. So we're very focused on that as well, regardless of ethnic or racial diversity or gender diversity.
Great. Richard?
Yeah, I completely agree with both Bill and Temple's comments. I would just add, from our perspective, right, I think net zero as a concept, as a framework, is really useful to unify, to help make this all concrete and actionable, but we have to be aware of unintentional consequences, right? We touched on some of those earlier, but especially around racial equity and social justice, right? Given the intersectionality that some of it is very mutually reinforcing, but some of it can be in conflict. For example, if we're transitioning our portfolio to all technology and healthcare, right? Carbon emissions probably will go down, but it then behooves us to think, okay, with some of the real opportunities around shareholder engagement to help high emitting industries really transition with intentional and scalable capital, I think that's important to keep in mind versus just making the changes in the portfolio. And there was a question in the chat box, I'll just paraphrase here, but especially in the muni market in the US, less affluent communities will have higher emissions because that's, tends to be where factories and highways are located. And of course, if all the capital flows out of those markets because of net zero commitments, right, you're looking at this disproportional harm for those communities, higher cost of capital, right? And we have to be thinking about that. And same thing in emerging markets, right? If the still developing economies, which are higher carbon, and they will be higher carbon for the coming decades, right, are seeing higher cost of capital because of institutional capital flows, right? I think the engagement piece can be a big part of it, but I think where you spend your carbon budget, to the extent you have some right now, and it's going to decline, right, and make it the most impactful as you can around both climate and racial and broader social justice is just, it's a really hard and complex equation, but it's one that's really important to solve.
Absolutely. Well, thank you all so much. We're a couple of minutes over, so we'll leave it there. But thank you again for joining us. Thanks so much to all of our panelists, and we'll keep these conversations going. I hope to connect again soon.
Thank you, everyone.
Thank you.
Take care.
Bye.
Thank you.